Welcome to episode number 31 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, and BTR. And I don't know if you've heard, but there's a tariff war going on, or at least starting to. And I saw a headline last week in the Wall Street Journal saying that tariffs offer apartment developers, and I quote, a lucky break. So how many of you in the apartment development business are feeling lucky right now because of tariffs? I gave a presentation last week to a group of apartment owners and asked them that question. Got a few laughs and some eye rollings and some depressed laughs, semi-depressed laughs as well, some disbelief, bewilderment, because the tariff debate, and I think this is a really important thing to remember, is that the tariff issue has really brought on uncertainty. Uncertainty among renters, investors, uncertainty in the economy. And that throws a pretty big wrench into things, both on the renter demand side as well as on the capital market side. Investors hate uncertainty. It has a freezing effect on decision making. So anyway, there's a lot of bad takes right now on how tariffs could impact apartments and BTR and therefore rents as well. I'm going to break it down in this week's episode with 5 observations on the potential impacts of tariffs on BTR and apartments, why the headline narrative is wrong. And by the way, this isn't just one of the things that where you can just, blame the mainstream media and for bad headlines. It's important to remember these headlines are being driven by bad takes from otherwise respected brand names in the industry, in both economics and in housing, including groups like Moody's and Redfin and Realtor.com. So the media articles that we're seeing are quoting them. So we'll get into that today. And then the real highlight is going to be an interview with one of the nation's largest apartment builders and developers, NRP Group, based in Cleveland, Ohio, but building apartments all over the country and all types of apartments from affordable to attainable and workforce to luxury market rate. In the most recent NMHC rankings, NRP ranked number 5 for most active apartment builder, number 11 for most active apartment developer in the country through both their third-party construction business as well as their in-house product. So we'll get NRP's take, a real-time take on the impact of tariffs from a group that's living through it right now. And we have the good fortune of being joined by not one, but 2 of NRP's executives. We have Chief Strategy Officer Scott Villani, as well as the president of NRP's construction business, Dan Hull. So stay tuned for that. A lot of gold in that conversation on tariffs, on the current lease-up environment, and how apartment development is and could continue to evolve for the next cycle. So that's going to be a great conversation. Hope you stay with us for that. Before we jump in, I want to give a big thanks to our sponsors. First and foremost, to JPI, another big apartment developer in Texas and California, and now elsewhere also. So thank you to JPI, and also to Madera Residential. So check them out at maderaresidential.com. All right. So as always, we'll kick it off with here's a chart. And instead of charts today, since all this stuff happening with tariffs is happening in very real time, so we don't really have it. We don't see how it's impacting the data yet. And I talked about this a little bit last week in our episode on the quarterly apartment market update, had Lee Everett from Cortland here. The data is still very good in terms of demand. We're seeing very strong demand. We're still seeing construction starts that have been dropping and were dropping long prior to the tariff conversation coming up. And we are seeing early signs of rent recovery that has nothing to do with a tariff-driven slowdown in construction. So not a lot to show in terms of data, but have 5 thoughts I want to share. Before we get into that, I want to make this comment first. When you think about tariffs, there's a lot of hot takes out there, but the reality is the range of possible outcomes is very broad. No one really knows for sure what's going to happen. A lot of what's happening right now is without good precedent historically. The real theme right now is uncertainty. Every time I read or see someone come out with a very strong definitive statement declaring how all this is going to end, from either side, by the way, I roll my eyes a little bit. Stuff like this is going to bring out strong views from both the bulls and the bears, but no one really knows, especially given the dynamic environment right now, how rapidly things are changing, negotiations are ongoing, headlines seem to evolve from one day to the next. It's possible even from the time I'm recording this to the time this comes out a couple of days later, things could have changed. So we'll see. But again, I think it's safe to say the range of possible outcomes is pretty broad. I'm not going to offer any big hot takes on what's going to happen. Instead, I'm going to give you 5 observations on what we do know so far, what's actually happening right now in real time, and what might play out as it relates to multifamily and BTR. So here we go. Number 1, the construction impact is likely lower than you probably think and what you've heard. I've talked to several large apartment developers, and they're all estimating impacts that are surprisingly low. They're generally in the low to mid single digit range in terms of percent impact on construction costs. Now, that's not immaterial. That's still, if you have, people sometimes forget outside the industry. These projects could cost upwards of $100 million. And so an impact, even the low to mid single digits, we're still talking about millions of dollars. So that's not insignificant, but it's also not the nail in the coffin by any means either. So a couple of nuances here. First and foremost, all the headlines on tariffs right now and their impact on housing often miss a very critical point, which is this. The spike in interest rates, that was far more of a supply killer than tariffs, at least directly, and at least, there could be other indirect impacts from tariffs, talk about that in a moment, but in terms of direct costs, the increased cost of debt and cost of capital was a much, much bigger factor. Remember, apartment starts and BTR starts, they began dropping off a couple of years ago for that very reason, the higher cost of capital, long before tariffs are making headlines. And there have been a couple media articles and commentaries lately, including people who should know better, like I mentioned earlier, saying that construction will drop off and rents will increase because of tariffs, but it's not that simple. Remember, it takes a couple of years to get projects planned, to funded, to started, and built. Any impact from tariffs on rents is a couple of years away. Even if those impacts on tariffs are bigger than the numbers I gave you earlier, the impact still won't be felt for a couple of years. So the reality is, again, tariffs are just another headwind for a business that has a bunch of them right now, from high rates, flat to falling rents, a big wave of new construction competing for renters. Construction numbers have been at the highest levels in 40, 50 years, although obviously we've been coming down off those peaks more recently, again, for reasons that had nothing to do with tariffs. So all those things push up vacancy. That's why starts were already down. And that's why if rents do start jumping back up this year because of reduced supply, it's going to be for those reasons, not because of tariffs. Again, that's a couple of years out. Now, second thing, as we look at how new projects could potentially be impacted by tariffs, the current estimates, again, that number I shared with you earlier, low to mid-single digits, they're not quite as significant as you might think. And our guests today from NRP Group, they're going to share similar estimates from their businesses as well, their projects as well, I should say. And there's a couple, you may be asking why that is. Well, there's a few reasons for it. Number one, you're going to hear from Dan Hull later. He's the president of NRP's construction group. And he makes a really key point. He notes that suppliers to apartment builders and home builders, they had already been moving a lot of the supply chain away from China starting back in 2018 during the first Trump administration. That really helps out now, given that the highest tariffs impacts are really targeted toward China. Second thing is that, Dan will also share this, we're hearing this across the industry as well, is that vendors for now are absorbing some of the additional costs from tariffs for not because of the generosity of heart, but because the market has been shifting again in favor of builders, and that's because of the massive slowdown in construction that, as I mentioned earlier, was already happening prior to all this. And so they're still competing for business. Now, that doesn't last forever, obviously, but in terms of immediate impact, that certainly is a factor that vendors are willing to absorb some of that or even all of that tariff impact. Third thing, when you look at specific materials, a lot of the impact depends on where you source it. For example, a lot of the apartment builders were already using American lumber, so the impact is minimal compared to if you're using Canadian lumber previously, at least in terms of the near term. Some of the things that are more impacted by tariffs are finish out materials like, kitchen and bath fixtures, also things like plumbing materials, electrical components, cabinets, appliances, doors and windows, countertops, flooring. But again, some of that has already shifted outside of China. So the impact just depends on where you're getting it from, who you're getting it from, when you're getting it. And some of that impact will also be offset or could be offset simply by changing suppliers from those sourcing in China to those sourcing, somewhere in Southeast Asia or Mexico or somewhere else where the tariff impact is much smaller. By the way, on this note, you may have seen or may have heard the CEO of related companies was on CNBC recently saying the tariff impact could be as much as 20%. But he did note correctly that depends on where you're sourcing materials from. So again, if you're a developer who's been sourcing Canadian lumber and sourcing most of your materials from China, the impact is going to be significantly more than the low to mid single digits number I gave you earlier. Versus if you've already diversified your supply chain more, if you use an American lumber, the impact is going to be much less. And by the way, here's a good stat. The National Association of Home Builders put out some research in December. Then they showed that in 2023, the most recent data available, analyzing some census data, China represented 27% of imports used in residential construction. That was number one among all foreign countries. But on the flip side, it means 73% of imports were not from China. And I'm guessing that number's probably gone up since then and it's probably going to go up more this year. And one last point on construction costs I want to share before we move on is that while the total impact from tariffs right now is probably pretty manageable for a lot of developers, especially those with scale right now, to be able to buy materials in bulk and things like that, the outlook could change if U.S. suppliers start to increase prices to capitalize on tariffs. That, I think, is a little bit of a wild card that hasn't played out yet, but it's something to watch closely that could change the story more materially. All right. Second observation. A bigger factor than construction costs is this: increased recession risk. And I'm stating the obvious here. Recessions are bad for demand and therefore rents. It's going to put downward pressure on rents in that scenario. Good news is that apartments and SFR tend to have a higher floor than other sectors. That's good news, of course, for apartment investors. Even during the GFC, for example, stabilized vacancy bottomed out around 8%. And that's not great by any means. Normal, for those who don't know, is more like 4 to 5%. But that's also by no means terrible. There's still cash flow in that scenario. I tell people this all the time. This is something that separates apartments from other types of commercial real estate. In an office building or retail or something else, if one or two tenants move out, you can be at 0% occupancy and zero cash flow. In an apartment building or in a sizable single-family rental portfolio, in most cases, the vast majority of your units will still be occupied and still paying rent every month. Now, that doesn't mean rental housing is immune from a recession. That doesn't mean your costs won't grow faster than your revenues, but it does mean there's usually still at least some revenue coming in the door. And in a recession scenario, we'd almost certainly see vacancy go up further. We'd likely see more rent delinquency as well, particularly in the lower tier kind of Class C product. And we'd almost certainly see downward pressure on rents. And I think this is one of the things I'll talk about later. It's a little bit bewildering. Is this idea that tariffs will cause more people to become renters? That doesn't line up with historical data. That's not how things work. When there's a recession, we tend to see more household consolidation and doubling up than we see of new formation. Okay, so again, pretty good floor comparatively speaking, but it's definitely not immune. All right, that takes us to observation number 3. If a tariff war results in economic slowdown, that could offset the looming supply slowdown and this rent recovery that investors have been banking on, especially in multifamily and BTR. And I've talked about this a lot in this podcast, which is that the mainstream thesis in multifamily and BTR right now is that the supply slowdown that started a couple of years ago was going to give way to a lower supply era for at least a couple of years. If demand remains steady, that allows for a rent rebound and a more attractive environment for apartment investors. Now, if a tariff war leads to an economic slowdown, that obviously changes the demand outlook, which then therefore changes the rent outlook. Let me share some comments made by Blackstone during their earnings call last week talking about tariffs. And specifically, I'm going to read for a moment a recap published in The Real Deal. It says, Blackstone CEO Steve Schwarzman said, tariffs will likely drive up construction costs and stymie new supply. That's a boon for real estate values, particularly in logistics and apartments, Blackstone's two biggest sectors and asset classes where development has dipped to decade-long lows. But that thesis only pans out absent recessionary conditions, Schwarzman cautioned. And that's a big but there. So here's the thing. Apartment supply and BTR supply, we're going to plunge anyway. I mentioned that earlier, this year and next year, regardless of tariffs. Starts are plunging way before tariffs made headlines. So again, any impact on tariffs is a couple of years away, given the time needed for projects to get planned, funded, started, completed. So if tariffs do indeed cause a further slowdown in construction, the real impact is going to be prolonging the supply slowdown into 2027 and maybe beyond. And that gives upside to investors that are banking on rents rebounding in a lower supplied environment. But, and this is the thing, again, we don't talk about enough, but Schwartzman noted this correctly, that the outlook is dependent on the economy remaining in expansion mode. And that's increasingly a big question mark. So again, you have that higher floor, but you're not immune to a recession. And in a recession scenario, the weak rent environment would likely persist longer. And then whenever the hypothetical recession ends, at that point, you could make the case that SFR and BTR and apartments are pretty well positioned for the next cycle. The supply slowdown is certainly going to help speed that along. And if indeed tariffs do result in less construction, that elongates that cycle as well. So again, there's just more nuance there than that I think Blackstone's correctly noting that otherwise I think sometimes gets lost in the headline narrative. Observation number 4. Uncertainty creates another speed bump for renter demand and deal flow. Okay. I mentioned the Blackstone earnings call, and I'm picking on Blackstone not only because they're big, but also because they're one of the few companies in the space that's had an earnings call at this point since tariffs become in the headlines. And the word uncertainty was in their transcript 10 different times. So everything that we're describing right now, everything we've talked about related to tariffs, it really boils down to one word: uncertainty. Economic uncertainty, which in turn creates uncertainty around the rent and NOI and valuation outlook. And uncertainty that impacts the outlook for both renters as well as for investors. Uncertainty tends to have a freezing effect on decision making. We saw this play out in 2020, obviously during the pandemic era, and then of course again in 2022, we saw the freezing of renter demand during a period of peak inflation and low consumer confidence that had a freezing effect on new lease demand. People had jobs and wage growth, but fears of what was around the corner left hundreds of thousands of people choosing to stay put in temporary living arrangements and waiting it out. So in 2020 is more of a capital markets freeze, and 2022, early 23 is more of a renter demand freeze. And so again, uncertainty weakens the demand outlook and the deal flow outlook as well. Just as we are finally starting to see a modest rebound in transactions for apartments in BTR, we could potentially see the market pause again, or at least slow down. I mentioned earlier in last week's episode, our guest Lee Everett from Cortland was on, and he shared some really good real-time market insight of some debt funds getting cold feet and backing out of early-stage deals. You know, that can if that actually persists, that can weaken the outlook for current investors looking to refinance existing deals, particularly at the lower end of the quality spectrum. It could also impact some developers and investors holding on to brand new lease-ups as well. With exit values that are well below pro forma. I think there's still more demand for that type of product from investors and lenders, but probably a bit less today than a few months ago. Now let's go back to that Blackstone earnings call again, and here's a comment that Steve Schwartzman made in his opening comments. He said, "Uncertainty around tariffs and their potential impact on economic growth and inflation has dramatically impacted investor sentiment. It's too early to assess the full implications of tariffs. Most important questions are: how sustained will this period of uncertainty be, and what are the second-order consequences both domestically and for foreign countries?" And then John Gray later added this. He said, "My gut is this period of time may slow some of the movement towards real estate, but as this recovery begins to take hold, I think you'll see capital flow back. We've seen this historically in the 90s and after the financial crisis. I don't really expect this to be any different. This may just create a little bit of a speed bump here." And I think that really just sort of captures the overall sentiment, not just for the big players like Blackstone, but even for smaller players, which is uncertainty is going to slow things down, but it doesn't really change the long-term bullishness toward particularly the multifamily sector. And that takes us to number 5. And I'm going to be stating the obvious again here, but the faster the resolution we have on the tariff wars, the better. I'm going to quote Schwartzman one more time. He said, "We believe a fast resolution is critical to mitigate risks and keep the economy on a growth path." And I don't think anybody is going to dispute that point. So the upside here is if these issues are resolved quickly, we could see apartments and BTR capital markets bounce back pretty fast, especially given the parallel slowdown in supply. Let's just quote Blackstone one more time. Here's John Gray, and I promise I'll be done quoting them. But again, I'm just picking on Blackstone because they're the first ones to have a first material player to have a earnings call since the tariff issues come out. So they have more public commentary than others. And John Gray said this. He said, the underlying facts of a lack of new supply, cost of capital coming down, that's going to be the foundation for a recovery in real estate. And I think investors will want to go to it. They'll be a little more hesitant in open-ended funds, probably more biased toward drawdown funds and fresh capital. But as we get deeper and more positive performance, I think real estate will start to get more traction. And indeed, Blackstone made a point of saying they're built for periods of uncertainty and have dry powder on hand. They said $177 billion in total. And they also talked about finding opportunity in the current market to play the longer game here, especially with public companies who could be frustrated with their stock prices and feeling pressure from their investors. So could we see more REITs taken private, as Blackstone's done previously? That certainly would not be surprising to see that play out. But it's also a sign that in a period of uncertainty, buyers will likely want more value, more assurance that they're buying at a discount, more of a discount than they would have had a couple of months ago. And the need for that type of value, if it's sustained, that likely caps total potential sales volumes. There'll be a lot of rallying calls out there among investors looking for opportunities. And they'll say, hey, we're going to get opportunities while others are sidelined. But that still only plays out to a limited degree because there's probably going to be a finite number of deals that most of those buyers will really consider, especially that are attractive enough to really consider, unless this thing really draws out for a long time. And if it does drag out, you could see more owners forced into selling for various reasons, but we're just not there yet by any means, not any scale. So bottom line is this: whether you're Blackstone or you're mom and pop Inc., you're probably going to be better off once this tariff uncertainty is behind us. The faster that happens, the better. And if you somehow time it just right, you're going to be happy about that. And then again, on the other side of this, if you're waiting for every light to turn green, and at that point, you're probably buying back in once pricings jump back up and competition for deals is much more significant than it is right now. So we're just going to have to see how this plays out. In the meantime, this bears repeating. The rental housing market for now is in solid shape. Again, if you want to have more on that, you can look at last week's episode, talked about the overview of the latest data through Q1, still big demand numbers, slowing supply, early signs of rent recovery, and where we go from here likely depends on where the economy goes and what role tariffs play, of course. So much more to come on tariffs in today's interview with Scott Villani and Dan Hull of NRP Group. They're navigating these issues in real time as a major apartment developer and builder, and they're gracious enough to open up their playbook for us with some really good real-time insights on the market and the impact that tariffs are having on their projects. So please stay with us for that. Before we get there, let's jump to rental housing trivia. All right, so this week's trivia question sticks on the tariffs theme, and the question is, I actually mentioned this earlier, that China represents 27% of imports used in U.S. residential construction in 2023, according to an analysis by the National Association of Home Builders. That was more than any other country. So the question is, which country ranked second for imports of residential construction materials? And I'll give you some options to choose from. Is it A, Canada, B, India, C, Mexico, D, South Korea, or E, Taiwan? All right, so give that some thought, and we will answer that in a bit. But first, in the news. All right. In the news, where we highlight some headlines that are impacting rental housing, give you our take on those. And sticking with this week's theme, we're going to give you 3 headlines all about tariffs. And so you haven't heard enough on tariffs. You will after the completion of this episode, at least until something else changes again. First headline is the one that I mentioned earlier. This comes from the Wall Street Journal, and it says, apartment developers who overbuilt luck out with tariffs. The multifamily industry can now pause most construction ahead of potential tariffs on building materials. I love that part. Can now pause. I can just pause it now. We have tariffs. All right. So the article goes on to say that, quote, with the cost of imported materials poised to soar and construction labor getting hard to find, this crush of overbuilding suddenly looks like a lucky break for the multifamily industry. And then all this is buttressed by a quote from a Moody's economist who says, they've lucked out. So the thesis here is that tariffs will allow a pause in construction, and then rents will rebound, and then apartment developers will luck out. But here's the problem with this. Number one, developers get paid to build. Tariffs create a higher cost to build. Construction was already plunging long before all of this happened due to higher rates and falling rents or flat rents in some markets, and tariffs don't help. I've yet to meet a developer happy about tariffs. Also, I alluded to this earlier, the idea that developers can just pause construction reflects a misunderstanding for how the business works. If you're pausing a project, that means you're out some money. You've got pursuit costs and or carrying costs caught up in these projects even before you break ground. And also, realistically, come on, if you want to pause construction, you wouldn't need tariffs as an excuse to do that. In fact, we saw a lot of the REITs had kind of paused their construction project, or not projects, their pursuit of new construction a couple of years ago as rates went up. And now they're only recently started getting back into it. Second thing, this is a really key point that I talked about earlier. I'm going to mention this again now. This article sort of acknowledges, but also glosses over in favor of the hot take on tariffs. And that's this. Apartment starts began plummeting 2 years ago, long before tariffs were in the news. So the truth is, if and when rents do increase meaningfully again, tariffs are not going to be the primary driver. It was the combination of already high construction costs plus the rapid increase in rates plus the flat to falling rents that crushed the construction pipeline. That's what drove this. So obviously, again, tariffs just add another headwind for construction, but any direct impact won't be reflected on supply until 2027 at the earliest, given the timeline needed to get projects planned and funded and built. But also, again, as I mentioned earlier, the impact, even in a worst case scenario, is likely much smaller than the impact of high interest rates. And again, I'll get more into that with Scott and Dan in today's interview. But what's also interesting is that even in this article, if you read down far enough, the Wall Street Journal acknowledges this by noting, and I quote, additional building costs related to tariffs will have a lighter impact. So that directly contradicts the headline, even though that part's true about the later impact. Third and final point I'm making this article, and then move on. You might argue, as I saw some did, that this article, the headline was just a typo. It's not apartment developers who are going to luck out. It's apartment owners / landlords who are going to luck out. And honestly, I think some owners may even think that, but I think they're wrong. And here's why. If tariffs do become a major headwind and a sustained headline, that's going to weaken demand and affordability. That's a negative headwind on occupancy and rents and valuations, thereby hurting apartment investors further. That type of environment also makes it tougher to refinance or to sell at a desired price. And those are all bad things for current owners, especially those who might have expiration dates coming up on current assets. All right, next headline. Now, before we just point fingers at the Wall Street Journal or other mainstream outlets, you got to remember is, number one, that Wall Street Journal headline was fueled by a Moody's economist quote. And number two, it's not just the Wall Street Journal posting these type of misinformed hot takes. We see similar things from a couple of industry publications and mostly focused on the for sale housing sides. Maybe we could excuse it in that way. This first one comes from Redfin. It says new tariffs could increase rental demand and hamper rental supply, which would cause rents to rise. Again, a few things here real quick. Again, any impact on tariffs and construction is a couple of years away, given the timeline needed to get projects started and completed. Number two, as we'll hear from NRP later, the impact on costs is not as dramatic as this headline suggests. Number three, the idea that tariffs could increase renter demand, as it says, that's illogical. If indeed a tariff war results in an economic slowdown, again, rental housing is not immune to that. We won't see a spike in renter demand. Renter demand would more likely drop off, as it has in past recessions. I've said it before, and I've said it again here. You look at it historically, apartments and SFR have always seen more rent growth when there's homeowner demand. A healthy homebuyer market where people are buying homes, that creates a better economy, more household formation, and a rising tide boosts all ships. I'm always perplexed why we continue to see people pushing an angle that just has never been true historically. So I don't know why it'd be true now. Third and final headline, Realtor.com. It says rents continue to fall, but the tariffs on imported steel and aluminum could exert upward pressure on prices. All right. Well, first of all, as many of you know listening, most apartments, especially now in this cycle, are built with wood, not with steel, and a higher share was already shifting to wood frame, particularly wood frame suburban, because even prior to the tariff spikes on steel, high rises were very tough to pencil out, given where urban rents are today. Second, the article says that the markets most impacted by tariffs are going to be Milwaukee, Oklahoma City, Memphis, and Cleveland, simply because they saw the highest increase in percentage growth in multifamily permits. But it needs to also point out that these were all low supplied markets, regardless of the total permit number or the percent growth rate in permits. And in all of those cases, the total multifamily permits are below 2,000 units. Some of them are less than 1,000 units. So any increase in rents resulting from low supply, again, it's going to have very little to do with tariffs, but just with being low supplied markets to begin with. All right, let's get back to this week's rental housing trivia question. The question was, China represented 27% of imports used in U.S. residential construction in 2023, according to an analysis from the National Association of Home Builders. That was more than any other country. Which country ranked second for imports? And the answer is Mexico, ranked number 2 at 11% of imports used in U.S. residential construction in 2023. I'm guessing that numbers will continue to go up, even with higher tariffs there than before. Still likely to be below China, even if a deal is made, or at least I'd assume so. By the way, after China and Mexico, Canada was third at 8%, followed by Vietnam, Taiwan, Germany, Japan, India, South Korea, and Thailand. All right, we're going to continue today's focus on tariffs and construction with the interview portion of today's podcast. I am super excited and honored to welcome in not one, but 2 executives from NRP Group with me today. Chief Strategy Officer Scott Villani, longtime friend of mine, and also the President of Construction for NRP, Dan Hull. NRP ranks as number 5 most active apartment builder and number 11 most active apartment developer on the NMHC charts. It just came out covering 2024 starts. NRP is based in the great city of Cleveland, Ohio, but builds all over the country and across the price spectrum, from tax credit affordable to workforce and attainable to market rate luxury. So I am thrilled to welcome in Dan and Scott for a very timely conversation on tariffs and the lease-up environment and the evolving environment for getting new deals started. All right, and now we enter the interview portion of today's podcast, and I am honored to be joined by 2 executives from NRP, Scott Villani and Dan Hull. So, guys, thank you so much for being here, and excited to talk about development and tariffs.
Yeah, thank you for inviting us. Appreciate it.
Absolutely. Well, I appreciate y'all making time for this. So, Dan, let me ask you the first question here. So you lead construction at NRP. Obviously, tariffs top of mind. This is the news of the day. And it seems like the headlines change almost daily at this point. It's dynamic. But what are your current expectations for how much tariffs could be driving up construction costs?
So for this year, we think it's modest, 1% to 2% maybe. So far, we've actually seen no impact, which is not uncommon. We're early in the game,
Yep.
and a lot to happen still this year. But for those that don't get into the goo of purchasing like we are on the construction side, it may be helpful to know there's a lot of things that are happening in how pricing comes together that reduce the headline impact of a 25% tariff or 100% tariff, or whatever the recent Truth Social comment is, right? But so, for example, Jay, the tariff is applied to the stated import value, not the wholesale value, not the retail value. It's not applied to labor or overhead or other soft costs. It's the stated import value of the good as it comes across a territory, which is pretty low, generally speaking, compared to the pricing that you're going to go into the grocery store to buy, or you're going to talk about with your framing subcontractor or anybody else. But the other thing that's happening a ton right now is vendors are simply absorbing what is coming across in levies in their margins. Um, this is a dynamic recipe of better way to say this. Uh, there's nothing formulaic in what's happening in coming up with these costs. This is a competitive marketplace with a whole bunch of moving dynamic pieces and parts.
Sure.
And as of today, we've seen no impact. And even on something like steel, Jay, that's probably had the longest run of not messing with what the stated tariff is. It's been 25% basically since January. We're actually seeing about a 2 to 3% increase in the last 90 days on our steel costs.
Wow.
So it grabs the headlines. We should be focused on it. We should understand it, but we don't see and are not projecting more than a modest disruption this year.
So Dan, let me ask you a follow-up question. You mentioned steel a little bit, but can you talk a little more about what materials have been most impacted by tariffs?
Yeah. So steel and aluminum is, I mentioned, none of the pauses, none of the exemptions that have been talking about the last 60 days apply to those. Anything you're getting from China these days is going to be hardest hit.
Yeah.
Now, fortunately, general contractors on any residential, multifamily, single family, Jay, they have a lot more options than they had in 2018. The tariff discussion in 2018 really started and prompted a years long push away from China. A lot of manufacturing has migrated away from China.
Interesting.
So there's a lot of options that we have today that we didn't have then, but still, many of your finished accessories in your units are going to be almost wholly provided for from China. A lot of folks are still getting their countertops, window coverings, a lot of light fixtures. Fortunately, on the plumbing, the kitchen and bath fixtures, those are expensive, but there's a lot of options away from China now. It was almost exclusive in 2018, but you can get great product in Mexico and other Southeast Asian countries right now that are good options. So,
and let me ask you a quick question on that. So, is that where these manufacturers are moving? Is it other parts of Southeast Asia and Mexico, or is that the themes? Okay,
correct. So. Like for NRP, for example, prior to 2018, we got all of our countertops from China, all of our light fixtures, plumbing fixtures from China, all of our flooring from China, except for carpet. All of our window coverings from China. Appliances were largely assembled and sent over from China. Today, fast forward 7 years, we get countertops from India, from Korea, from other Southeast Asian countries. We get tile and vinyl in countries away from China. Assembly on stuff like appliances is largely done in the United States, except for that most folks still have to buy their computer components from China. But that's a small portion of what is going into the overall appliance product, using that as an example. And so an appliance tariff, a China tariff as it goes into an appliance cost is pretty muted in its cost impact, because only a piece of the overall assembly is stuck in the China levies.
Let me ask you another follow-up question, Dan. You mentioned earlier that so far vendors are absorbing a lot of those costs. Is that something you think is sustainable, or are you kind of bracing for more down the road, or how do you think about that? If you could even guess where that might go.
Oh no, good question. I think there's more to run. We're in the 20. We're in the third year in a row now where we're projecting starts lower than the prior year, and the home building side is in the same boat. And purchasing costs generally across the industry is really led by demand in the single family side. Our multifamily is all we do, but and it's a big thing for us because it's all we do. But of all the residential purchasing happening, multifamily is a pretty small slice.
Yeah.
And so when you have multifamily and single family both having lower starts again for the third year in a row, that's a lot. We have an increasing competitive marketplace to buy in. It's good for us. I think it will. I think it will dissipate this year. So we think the cost increases are a second half 2025 timing. So I think it will come to an end to answer your question, but second half of the year.
Okay. Scott, let me bring you in for a question, unless you want to punt this one to Dan. So obviously tariffs equal higher costs, and that's never a good thing when it's already tough for these projects to pencil out. As Dan sort of alluded to, it's been a tough market for starts, and even before tariffs became part of the equation. But for comparison purposes, is it fair to say that today's higher rate environment, which obviously goes back a couple of years, that created a bigger math problem than tariffs have?
Absolutely, it hasn't helped. That's for sure, right? When we look at what NRP does as a development product set, and we are a new development shop. We don't do acquisitions. We're purely new development. We're vertically integrated, so development, construction, management, asset management, all in the same organization, and we run the gamut from affordable through workforce attainable all the way up to luxury market rate. And really, when we see things change in the environment, we look at which products are the ones that are going to suffer, which ones are going to succeed. How do we lean into one and lean away from another? And that's been part of, I think, how we've weathered a lot of these cycles is deciding at the point when rates go up, it makes affordable originations much more challenging, right? Mm-hmm. So due to the duration. On the other hand, we looked for opportunities in our workforce, our mixed income communities that were incentivized in places like Texas, PFC projects, for example. And we leaned into that and we said, okay, if it's risk off in certain areas and high rates are challenging affordable, people are looking for low basis, is what we said. And that's where we shifted our focus to. And we're able to do that. We're always looking out ahead, but we're able to do that because we have the skill set, under the same envelope to make those changes. And we have all of our developers in markets. So they're in each market. We have a corporate office in Cleveland and a corporate office in San Antonio as two sort of main corporate hubs. And then we have offices in all of our markets with our developers sort of on the ground intelligence.
Yeah. And then, Scott, the reason I bring that up is, you and I both, I think, saw that article in the Wall Street Journal last week suggesting that, tariffs were a good thing for apartment developers. And I think what it really missed is the fact that and Dan alluded to this, is we've been down on starts for a couple of years. And obviously the higher rates as well as, costs and low and flat rents in a lot of markets or falling rents in some markets have been really crushing construction long before tariffs became part of the equation. Is that right?
Yeah, I mean it's something we've looked at it. The market due to high rates, due to the pending oversupply. A lot of that in the news as well, and I think we'll get to that soon. But what we look at is you still have to execute through that cycle, right? We're looking to find ways to do that. And it's something that, frankly, we just address as it comes. We can't change the macro. We're going to go with what our product can take us to.
Yeah, absolutely. Dan, back to you for a moment. Let's talk about construction labor. This has been another hot topic given the crackdown on immigration. Are you guys seeing any sign of a labor market tightening? And if so, could that become another factor that drives up costs? Or is the slowdown in construction that you talked about earlier, is that creating more slack in the labor market and putting downward pressure on labor costs?
Yeah, no, it's the latter. We're enjoying after 21 and 22 and scrounging to get enough labor on the job. We're getting more labor on the job, right? It's pretty simple. We're completing a lot more units today than we're starting. and it's creating job sites that are going faster because there's more people there working, and it's creating more downward pressure on wages. They've flattened out, or they've been a source for some of our vendors to kind of tighten up and be more competitive. So we're going to enjoy that as long as it lasts. I do think, Jay, it's probably short lived. We'll see what the effects of a tariff trade war are, but if the stated goal of the administration is to create more jobs here at home, and I don't see a lot of general slack in the labor market, and this could be eventually lead to rising wages again in pretty short order. Perhaps as early as next year. So it's something we're keeping our eye on, but we're enjoying some good times while they last.
Yeah, very good points there. Scott, let's talk about the current market. Obviously, we have a massive number of recently built apartments in various stages of lease up. You allude to that all over the country, especially Sunbelt and mountain markets and certain parts of some of the coastal submarkets. What are you seeing in terms of lease up performance, in terms of velocity, rents, concessions?
Absolutely. So we open about 15 lease ups a year, right? So it's a mix of market rate and affordable. And we're in Sunbelt markets all the way up through the Northeast and Midwest. And broadly, we're able to lease at the pace we're looking to, but the concession environment is real, right? So on a market to market basis, we're typically looking for, in the slow season with, seasonality wise, 5 to 7 leases per week. In the high season, 7 to 10 per week. That'll keep us on our lease up time track. So we're typically leasing 300 to 350 units, somewhere in between there. And we are contending with the supply at a sub-market level, and that's where we spend all of our research time. So when I look at places like Jersey City, DC, Orlando, Dallas, less concessions, easier to get to our target numbers for our lease up and compete, because really the demand supply balance there is more stable, right? It's more equal. When we get into the tougher markets, again, we're on the ground in the details with our teams, getting the feedback from our digital sources, from our ad sources, and making adjustments. But a lot of times it's coming down to price today, where you've got that competition in the market. So we're taking our product, we're making sure people can express the value of it, that our teams on site can sell that. And we're also strategically doing things with lease terms and with concessions to hit our goals.
Yeah, that's great points. And it's interesting, today's market, you mentioned price being so important. And as I look at the data, a lot of it's not about affordability of the rent for these renters. It's really about just finding a better deal, sometimes newer product. And so that kind of leads me to my next question for you, Scott, is, in the industry, those in the industry are familiar with the concept of the year 2 hangover. For those who don't know that term, it's basically you offer somebody a concession, they sign a lease, and that way when that concession burns off or goes away, their rent will go up, not as a function of the base rent going up, but that discount goes away, and they may go chase another concession from another property, those concession chasers. And so that's when you have potentially another vacancy issue trying to deal with the initial move-ins now being move-outs. So Scott, my question for you is, how problematic is the year 2 hangover for lease-ups with concessions burning off, since renters still have plenty of other lease-up options in the market right now?
Yeah, absolutely. So we probably spend as much time on our renewal analysis as we do on our new lease pricing, right? Mm-hmm. So we're always taking a look at that. Our best tool through this cycle has been managing our lease expirations, right? So coming into where we're seeing at a submarket level, we're seeing that supply come in, and you can see it coming, right? If you're in a particular submarket, we look at it, renters choose the submarket first. I can see 300 unit apartment buildings being built 18 months out, 24 months out from when they're going to deliver. So I'm able to forecast when I'm going to see units in my market, and I'm looking to place lease expirations, later in that cycle, right? I don't want to overlap right when they open. I want to try and stretch those expirations. So today, when we're getting renewals, absolutely we have pressure in a lot of places. some of the things we've been doing with concessions up front, we keep them up front in bulk. And that helps us keep that lease payment on track as we go. Even if we're giving a flat renewal at renewal time, that to us is, it's a pickup because we're not paying that concession again, and we're not having to compete for renters again and increase ad spend. What we're actually seeing today, though, in some of these markets, we've started, when we look at our renewal strategy and our new lease strategy, to say, should we tighten up our lease terms, right? We went to, when the supply started in 23, we started to go to 13, 15-month leases on open, even on renewal as well. And now we've said, well, do we want to crack at these again in the summer of 26? And depending on the market, we do, right? So that's where we're starting to see markets bottom. Sure, it's competitive today, but that renewal, we're pricing that, for the next year. And we're trying to think about when we're going to get that back again. When's our next opportunity to realize the value of that asset?
And how much does that vary by product type did you have? How much does the product matter in that strategy?
Absolutely. So product absolutely matters in this case. And one of the things we like to think about is, if you have a durable competitive advantage, right, you can somewhat defend your price level in these markets. So where does that competitive advantage come from? How do you formulate it? We're on the front end. As I said, we have developers in market, right? They're looking for sites and locations. We focus on employment hubs. We focus on areas that we believe, are in the path of development and are going to see outsized demand for the supply that's currently in the market today. When we think about product influencing that, it's one of two things. Either you're choosing to, from a market rate standpoint, compete and be at the top of that submarket, or take a perspective on that submarket that creates a customer target for your asset that is different from the others. An example of that would be, instead of getting into a box checking exercise on amenities, which with today's cost environment, you can't do. Also, through our experience, we've found that not to be the best way and not the most accretive way to go about spending your money on amenities. What we've done is we've said, do people need the catering kitchen in the lobby anymore? Are they really using that? Right? We all, it turns into office storage, right? At some point. And what we've chosen to do is we've said, all right, well, maybe we're not reducing our overall amenity space, but we're going to give that space to fitness, or we're going to give that space to work from home. But instead of building a cafe style, what our residents have told us is, give me something I don't have in my apartment. So what we've given them are those private spaces. So we do 6 to 8 conference rooms, starting from one person to multiple 2 or 3 to one big, 6-person conference room. Things like that, we found people don't miss the other items. And what they're saying is, this is what I need. They're giving me more of it. We're going to direct traffic there. So while we may not avoid the concessions in the market, we will see the demand. And that's what I believe sometimes is keeping our product at the top of the market and keeping our absorption steady in some of these markets.
Yeah, that's good feedback. So as we're talking about product type, obviously NRP, you guys build the whole gamut. You got affordable, attainable / workforce, whatever your word of choice is, and market rate luxury. I'm always curious, what are the differences in the actual product that you build for each of these categories?
Sure. So, the mission at NRP said we're from affordable to market rate. Our mission is quality housing regardless of income.
Yeah.
And so when you look at in unit and you look at the general finishes of that unit, you won't find a drastic difference. That's not really where a lot of the differences are between it. It's more sort of structural to the unit mix and to the amenities when you're thinking of the customer targets. So our affordable product primarily targets families. And so what you're going to see, with families are larger unit types. So more 2s, 3s, and 4 bedrooms than you would see in a typical market rate community. So if a market rate community mix was, say 65-35 1s and then 2s plus, you might be in an affordable in a 50-50 or even sort of a 30-70 scenario where you have a really small amount of 1 bedrooms and your vast majority are 2s and 3s for those families. But where the differences occur beyond just unit mix would be amenity programming. So at a community where you're targeting families, you're wanting to provide amenities that assist them in their daily life. So you're thinking things like playgrounds, right? Like after school facilities, right? For programs that you're going to be collaborating with other partners on, nonprofit partners to bring in after school programs for the kids. Thinking about how is the bus going to stop at our community, right? Just simple things like that to make life go smoothly for our residents. We try and do there. At our market rate communities, school age children are such a small portion of that.
Yeah, you never see playgrounds in those places, right?
You almost never see them. Essentially, it's, we a lot of times get toddlers. That what we have sometimes in our market rate communities would be a kid's room off the fitness center. For those, smaller children, not school age yet. But really you sort of tilt the product, more towards more towards that young professional as your target there.
Yeah.
And that's really, the unit finish differences, they come down to appliances and some of the fixtures. But you're growing your kitchens, right? As you grow through those unit plan types, of the market rate product. The workforce sort of sits in between the two and has all the best practices of both. The thing the workforce product does is it really streamlines how you deliver those units and what the product is, unit to unit, how you can create the most efficiency possible. You lose variety, but you're competing a lot of times on price, right? You're sort of going straight at it and saying, this is a commodity product. I like to use the analogy of hotels and Marriott, right? So when you look at their range of brands, our range of brands, are similar in that, you've got the Marriott hotel that we know is kind of the straight down the middle, reliable luxury. And then you've got something like a Courtyard or a Fairfield Inn. And that's where you sort of look at a Fairfield Inn, a Courtyard target. Is a lot of times what we're thinking for workforce housing is you want it new, clean, reliable, and something that, is conveniently located to my job, right? And that's where we're looking at the marriage of all these products. And, maybe even Dan could speak to, a lot of our product types, we're a wood frame builder primarily. And so the practices we use across all of our product types, we can really start to gain some efficiencies. Dan, do you want to give a couple examples of that?
Yeah, it allows us to. One of the things it allows us to do is do a lot of bulk purchasing to get our costs down.
Yeah.
So we'll buy sometimes contracts that really span multiple projects at the same time to really lever up on our ability to get overall costs down and allow all the jobs to benefit. So the consistency of application across those products that Scott's talking about really helps us to get our construction basis down at a spot that we can execute on.
Yeah, that's a great point. I've talked about this previously, but I think that the ability of groups like NRP and some of your peers to be able to buy more in bulk in an environment where margins are already thin for development is a big reason why I think we're going to see larger developers take on a little more market share than they have traditionally, given that, all throughout history, even still today, apartment development is very local, right? But it does give a big advantage to groups like yours and others. Scott, let's go back to the current market. You alluded to this a little bit earlier. Let's get a little more depth here. Everyone's always looking for, hey, what market's going to be first to recover? Where's the next wave of starts going to happen? And so you guys, you're operating, you're building all over the country. Most of these major markets across the U.S. Where do you think we're going to see the first recovery and the next wave of starts?
Absolutely. So, part of the luxury we have with doing so many developments each year is we've got kind of a live laboratory, right, to take a look at how things are performing. We're also constantly assessing new projects as they come across to us. So when we look at it today, what we see is a market like Dallas. We sort of look at it like it's like the private sector DC. It's steady. While it has what would look to be high supply, it's very balanced with high demand as well. And we've seen that perform well. And we expect that to continue very, stable growth. Some other ones, though, that we're looking at, we see a lot of potential in Las Vegas. We entered it a couple of years ago. What we saw there was a real imbalance between the demand side and the supply side. And that's why, our lease rents went up very quickly into COVID. And we believe, we were already seeing it. It bottomed, I think, a few months ago, and we're already going to be on the uptick there. The overall volume of units coming into that market is so low compared to almost any market with equal employment size that we do business in. We expect it to outperform for the next few years. Another one right in the neighborhood is Phoenix, right? And Phoenix and Vegas were some of the first ones down at the beginning of the downturn. Our belief was a little bit because their primary product type is 3-story surface parked. So it delivered faster. They just had supply faster than other markets did, is what we think has happened. We also see Phoenix, and certainly in the eastern side of Phoenix, out Mesa and some of those markets near the high-tech industrial corridor, we see that making a recovery by the end of this summer. We see very little under construction. Most of it is finished or is finishing in the next month or so. There, as we said earlier, markets are being uniformly, sort of punished for the rate in the risk-off environment in multi, but we see that as an opportunity today because certain markets, I think, are being overcorrected.
Well, and Scott, real quick to your point on that is there's a big difference right now between East Phoenix and far West Phoenix.
Absolutely, yes, and that's where I think, again, you've got to be in the submarket level details because you could paint a broad brush and say that, rents are still trending down in there. But when you have developers on the ground in market and you spend as much time as our team does, you'll find submarkets that are performing well and are getting an outsized number of jobs coming to them. And that's what we're looking for because that's our customer target. That's where we're going to hit those young professionals and people newly moving to those areas, right? That's what we're looking for.
And what about Florida? Anything you're seeing there?
Yeah. So, Florida, Orlando and Tampa, we've had 3 or 4 lease-ups in those markets over the past year, all performing well. We had a little jump in concessions over the slow season. We're actually seeing them start to come down now. Absorption has been really stable in both of those markets. So they're both still very strong today. We see it as something that, you can rely on the job growth within those markets. And, it's a real positive story in that sort of Central Florida and the West Coast there.
Yeah. I've mentioned this previously, but Tampa is now the first major Sunbelt market to see rent growth on an effective new lease basis return positive. Orlando's not far behind. And Scott, like we said, I like Dallas being described as the private sector DC. I'm going to steal that line. That's a good one. So let's get a little more specific then. Okay, you got markets you like, sub-markets you like. What types of projects are penciling out right now, and what, if anything, are you changing in terms of finish out, floor plans, location types, et cetera, to reduce costs and get project to pencil out? Any kind of special sauce on the efficiency side to help?
We're always working on efficiency, and I'll let Dan give us some details on that in a minute. But, today we are really focused on the product strategy and the product execution in a market to find really a spot that can work for us. There's no one answer. I think when we get into a market, we're looking in Charlotte, let's say, and Charlotte it does have heavy supply, right? And I think we'll continue through the end of this year to see that supply and those concessions stay on. But what we find is we find opportunities to use mixed income housing programs. We find opportunities to get sites that maybe we can have a little lower density to get a lower basis product. We lean on our affordable experience to be aggressive in underwriting of those mixed income communities because we know how to manage it. We know how to underwrite it, and we feel confident in that. The other thing I'll say, though, is because we build 3-story wood frame across all product types, there are opportunities we take to find those efficiencies and tag them on along the way to continue that pipeline. And Dan, you could probably speak to a couple of those things that we've been continually evolving our product, in the sticks and bricks, behind the walls, in the ceilings, things that people, we're not trying to cheapen your unit finish or give you less space. We're trying to take the efficiency out of the things that we control.
Yeah, we've reduced. We've gone back and said, do we really need as much room as we've been putting in our clubhouse amenity spaces? And can we do that over a smaller footprint but provide still the same amenities? We're designing less cut up roofs and less dramatic articulation in the elevations. Other things like that can still provide the same amount of floor plan space to the renters, but spending less structural costs to get there. The other thing that comes to mind, guys, is it's not so much a design cost cutting issue that to me is a common thread across what we're being successful with is something that becomes really apparent as we look across our third-party business. Jay, about 7 or 8 years ago, we started doing third-party construction for other clients rather than only being a builder for ourselves. And the normal way of doing business across all our stakeholders, right? Whether it's in-house or third-party, is whether you're working with your general contractor getting a price, or you're working with a bank and getting an MOU, you're working with an investor, you kind of hold your cards close to the vest, trying to maximize your part of the deal. And that works really well, say 3 years ago, when the return metrics are kind of more or less understood. The exit caps are more or less agreed upon. When the costs of your construction is kind of understood between a set of guardrails. And when the Fed rapidly raised their rates, it threw us all into price discovery. And we're still there, right? And so as an example, what's in my head is on the third party side in the last 18 months, Jay, we've been awarded something like 18 or 19 projects. 7 of them actually moved forward.
Wow.
In all 7, the developer and owner and the investor and us as the contractor got really transparent with each other on what do we all need in order to make this deal happen. And it's only in that really deep transparency that the creative paths to successful underwriting and closing are revealed. And when we get stuck in the old ways of I hold my cards really close to the vest because that's how I maximize and protect myself and my business, you never see the path to get over the hump and over the barriers and the obstacles to get closed. And so if you're struggling, let's look at product. Let's look how we get our basis down. But you probably need to look at your stakeholders and yourself and say, am I really being transparent enough with each other to reveal the path forward?
Yeah, that's a great point. I'm sure it applies to other areas of business too, and beyond construction. I like that. So let's talk about this kind of the next, where we go from here. I know you always want to be careful about not overreacting to the current moment too much. I think back to coming out of the great financial crisis, we saw a lot of developers start to build really small units. And then when leasing came back, the smaller units sat empty longer and the larger units leased faster. And so you want to be always careful about that. But how do you think the next evolution development will evolve? What's it going to look like? Last couple of years, we've seen more dens, work from home spaces. How is it evolving? What's next?
Yeah, the funny thing when you bring up dens, we started putting dens in buildings 10, 12 years ago, and 1 den units specifically. The reason we did it then was for a value 2-bedroom, right? When people were doing smaller square footage, like you just mentioned, for that sort of chunk rent price that we're after, what we saw was you could get 2 occupants in a 1-bed with a den if you had that extra space for the office before people really had a home office. During COVID, dens became luxury one bedrooms for a single person, right? But we see them still having a function in both markets. Sure, we might shift mix a bit, but we try and not overreact to what's happening. We want to keep an eye on where the market's going. I'll give you another quick example with BTR product. So we looked at it extensively. We executed one, and it went well. But what we looked at after analyzing the data from our projects and for projects nearby was that we would be better served taking a 300 unit community of flats, right, say a 4-story project, and inserting 24 townhomes next to it, sort of a BTR competitive product. And having the operating efficiencies was the primary motivation for us. But what we found through execution later was that having the amenities was a bigger driver to the success of those units. So we were driving higher rents than other BTR communities purely because of the access to a full physical plan for 300 residents of amenities rather than sometimes, just a small clubhouse kind of off to the side. So we set the path with BTR for NRP would be making it part of our mix. And that's what we've done on multiple projects and will continue to do as we go forward. So another thing that we've been looking at and Dan's been spending a lot of time on is modular, right? We know today people are starting to execute some projects, some workforce projects in some affordable. We believe that's something that from a construction standpoint, we want to stay very close to. And from a development standpoint, let's find opportunities to give that a try. And, broadly though, we look at it, as our product types, we need to continue to refine them, but more importantly, we need to be able to have a broad array of products to address whatever the market's doing at the time and the location that our team's able to get under control.
Well, great. Well, Scott and Dan, I really appreciate y'all sharing some of your playbook with us today, and wish you all the best in this next cycle.
Thank you, Jay. Appreciate your time.
All right, and that's a wrap on episode number 31. Apologies, went a little bit longer than usual today. I like to keep these under an hour, but we had a lot to cover on tariffs, been a lot going on, obviously. Hope you enjoyed the conversation with Scott and Dan. Big thanks to them for joining us. Thank you to our sponsors, JPI and Madeira. Thank you to all of you for spending part of your day with us. We'll see you next week.